had in the first quarter. So in that sense, there's more clarity about the strength of the economy. But the question is, what's the economy going to look like in the second half of the year?
Can you answer your own?
They're telling us.
Answer your own question.
No, I think what they're telling us is they see that these, even though we don't know the size of the tariffs and, where they're ultimately going to land and their effects, that they are going to hold here for now because the impetus from those tariffs are higher inflation, at least for a time, and a bit weaker growth and a little bit higher unemployment. And they need to do what they have to do, as the chair has been telling everyone, to make sure that inflation and inflation expectations remain anchored. So even though they may look through the price increases that come from tariffs, there's no compelling reason for them to make a change now in the policy rate with the economy performing pretty well, and there's still uncertainty about the second half. So I think they made the right move today by doing nothing with the funds rate. And I think the withhold and see until they get a little more clarity. As one of your guests had said, we also have the budget bill working its way through Congress, and that'll be part of the outlook as well. So I know you were talking, Brian, they can just change the those dots whenever they want.
You were the one making the plots, the dots on the plots.
Right, but remember, we change them. Any forecaster will change them based on incoming information and how that informs their outlook. So I don't think it's a bad thing that the forecasts are responding to incoming economic data. I think that's a good thing. And I think it's the change from one SEP to another that's very informative. And I think today we got informed that, the bulk of the committee is thinking that we're going to need a slightly more restrictive policy stance than they had thought at the time of the March meeting. I think that's very clear in this.
And I don't,
this SEP.
I agree. I mean, you change your forecast for anything based on your known information at the time, right? My flight will land at 4 p.m. Then it's delayed because you chose to fly out of Newark, sadly. So you got to call and say, well, I'm going to be delayed. I'll land at 6. You change your expectation based on what you have at the time. I guess my point, Loretta, was when I look at the CME's FedWatch tool for next year, I see 6 different expectations, all within a relatively similar band, variance a little bit, of ideas. These are some of the smartest, like you, economists in the world. And I guess my point is there doesn't seem to be a lot of visibility to next year.
Well, I think that underscores what the chair has been saying, which is there's a lot of uncertainty still here. But, when you're doing this kind of policy making, you're doing 2 things. You want to minimize the risk that you're going to make a policy mistake. And you also want to minimize the cost of any policy mistake you might make. So right now, it's not that costly to hold, right?
Yeah.
The economy is doing well. The unemployment rate is low. Growth in employment is holding up.
We should have Jerome Powell stepping in about 3 minutes, 2.5 minutes. Just be aware of the chat. I'm going to go ahead and post how interest rates and how, you're probably already watching the stock market, but how interest rates are responding. That's the key thing here, how rates respond to each comment. And I'll have that in the chat if you have questions and if you also want to comment. Back to the show.
Going to get SEPs, you're going to also have a lot more economic data coming in.
Well, the bond market, somebody said earlier, somebody said earlier in the show, they don't buy barrels of oil, Loretta, but they use gasoline. I thought that was well said because most of our viewers and listeners, they're not trading interest rate futures, but they might want to buy a home. And they're watching mortgage rates. And the bond market already did move.
No, that's true. But also think about the way people's expectations about future inflation are formulated. The gasoline price is one of those prices that really matter in terms of inflation expectations. So what I expect to hear in Jay's press conference today is that the Fed is still, very focused on making sure that it does policy that will actually support that
Mhm.
anchoring of inflation expectations. And I think that's part of what they're doing with this hold and see strategy.
Loretta Mester, we're sure glad you're on our team. CNBC contributor, super smart. Thank you.
Thanks, Brian.
Thank you very much. All right, let's bring in now our senior markets commentator, Michael Santoli, as we await Jay Powell. Is it Mike? We got an empty podium, but soon to be filled by Jay Powell. Is there anything the market wants that podium and the person behind it to say?
I think the market always wants the Fed chair to convey a sense of flexibility and willingness to move relatively quickly in response to data, in particular if the economy does weaken from here. I'm also interested to hear how Chair Powell characterizes the summary of economic projections, the dot plot, because there are times when he says, oh, he tries to dismiss it. You know, we just write this stuff on a piece of paper. It's not an authoritative plan or outlook. It's not definitive guidance. And there are some times when he kind of leans back on it and says, look, the committee is not prepared to work yet. It's interesting that you have very few members below the median in terms of rate cuts. In other words, who think there could be more than 2 rate cuts this year. And you have 9 members who think there could be none or 1. And so to me, the skew is the barrier is pretty high for cutting rates right here. An investor has to assume the Fed's kind of not part of the game for the next 3 months because you got an end of July meeting, you got Jackson Hole, then you're talking about September, which means good news for the economy is what you're rooting for. Good news is good news now.
20 seconds. Softball. How much does the Federal Reserve even matter right now?
I don't think they matter a ton right now. It's market rates. It's like the longer term part of the Treasury curve. And because the Fed has intentionally taken itself to the sidelines and trying to make full use of this luxury of what they perceive as a luxury of patience right now, because they don't see any emergency on either side of their mandate. You can argue about
here he
that,
comes.
but they don't see it.
I would say the man behind the curtain, but he just came around the curtain. Federal Reserve Chair Jerome Powell.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP, as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market, conditions have remained solid. Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March. The median projection declines to 3.6% at the end of next year and to 3.4% at the end of 2027, a little higher than the March projection. These individual forecasts are always subject to uncertainty, and as I've noted, uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy strategy and communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Colby. Thank you. Colby Smith with the New York Times. To what extent has the more limited impact from tariffs at this stage on inflation changed your view on what the ultimate economic fallout will be from these policies and the timing of when they will materialize in the data?
So we've had 3 months of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effect of tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
So in terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about, responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And, our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chair. Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjust it over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you ended a higher rate at 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
So I would focus most on the nearer term as you get out to the later years. It's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April after the March meeting that substantially higher tariffs were likely, and then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that they do. So and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the world will be over.
No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's an accurate statement.
Thank you. Chris Rugaber at Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back at roughly 2% despite the tariffs. And I guess I also wanted to ask about, cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data, including this morning, that have been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5%, 2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market. And that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true? And how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place? So
this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for say, inflation and or growth or the unemployment rate, how many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see whether, to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point, it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and I think all estimates are now pretty close together, but it's highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But the pass through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff, but together they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict, and we haven't been through a situation like this. And I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data, and again, in the meantime, we can do that because the economy remains in solid condition.
Nick Tamarosa, the Wall Street Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook, or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts. And they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So that you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things. And I think as the data come in, you should see those differences diminish.
If I could follow up, you've said the policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not, we have to be forward looking. And the thing that every forecaster, every outside forecaster and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months. And we have to take that into account. So I think a backward looking look would lead you to a neutral stance, but we can't, we have to look at that. And because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass through of inflation and what's going to be the effects on spending and on hiring and all those things.
Mr. McKee.
Michael McKee from Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction. And I'm wondering, given now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers about the outlook for the economy.
Okay. From my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with strong labor market and price stability. That's what we want. We think our policy is well positioned to right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy has been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us. Pretty much that's all that matters to us.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Andrew.
Thanks, Mr. Chairman. I guess with workplace raids increasing, picking up significantly, what kind of effect would that have on the labor market?
Sorry,
in the short
with
term?
what picking up?
Workplace raids.
So you're asking immigration?
Yeah.
You know, I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means like part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SEP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into, into discussions about, specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SEP is part of it. Many other ideas. It's sort of how do we think our communications can be improved? There are a number of ideas. People offered a really, it was a great conversation. Number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, I would only support things really that only implement things that have very broad support. And also you want to be really careful because I think our communications are pretty well received. They're not broken. So more is not necessarily better, but better is better. So we're going to be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Thanks, Chair Powell. Kelly O'Grady, CBS News. You're famously known as the guy that makes decision based on data instead of speculation. You've said today the inflation data is in a good place. We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that you cut rates in December, and there was still the what if of tariffs. So what made you feel comfortable cutting then when inflation was higher than where it is today and you didn't cut today?
Well, the forecast for inflation in December was 2.5. Core PCE for 2025, the forecast was 2.5%, which was a good inflation forecast. I think what we've learned is that, and this was long before we had any idea of what the actual policies would be. We've learned that tariffs are going to be substantially larger than forecasters generally thought. And, we don't, our forecasts are generally not particularly different from those of other, well-resourced forecasting operations. So what we learned, and particularly in April, was that very substantially larger tariffs were coming and that would mean higher inflation. That's what happened. And so you saw 2.5% forecast in December, you saw 2.8% in March, and you see 3.1% now. So it's 0.6 higher inflation for 2025. And that's a big part of the change. And that's due to the effects of the tariffs that are, we don't know where they're going to land, but it's pretty apparent they're going to land higher than outside forecasters were really guessing at the end of last year.
My follow-up to that, I think consumers, right, we're looking for relief on rates when it comes to mortgages, car loans. Small businesses want to take out more manageable loans. When you look at the cumulative inflation over the past 5 years, prices have risen over 20%. It's been a rough road. So what is the tipping point then for the wait and see approach in terms of how much it's going to help versus when it hurts the American consumer?
Well, I mean, we're trying to restore price. Best thing we can do for the public that we serve is restore price stability. If we can, and we will, restore price stability, meaning 2% inflation on a durable, sustainable basis. That, and also maximum employment. If we restore those things, that's the best thing, and that is our goal. The best thing we can do for the American people, for households and businesses, that is the ultimate thing that we can deliver. And they can make their decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high, let's be honest. I would say policy is modestly or moderately, probably modestly now restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably modestly restrictive. And so what it will take is confidence that inflation is coming down. Now, I would say without tariffs, that confidence would be building, because if you see what's happening with non-housing services and housing services, which are the other two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects, and then we could start to make a better judgment. So that's what we're doing, and I think we can take the time to do that because unemployment is 4.2%. Wages are moving up. Real wages are moving up at a healthy clip now. And inflation is 2.3% headline inflation over a 12-month basis. So it's a good economy and a solid economy with decent growth.
Thank you, Chair Powell. So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that every forecaster you can name who is a professional, forecaster with adequate resources and forecasts for a living is forecasting pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs because someone has to pay for the tariffs. And it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer, ultimately somebody putting it into a good of some kind or just the consumer buying it. And all through that chain, people will be trying not to be the ones who pick up the cost, but ultimately the cost of the tariff has to be paid. And some of it will fall on the end consumer. We know that because that's what businesses say. That's what the data say from past. So we know that's coming. And we just want to see a little bit of that before we make judgments prematurely.
And follow up on that. So you spent years though talking about how you're data dependent, and be a little more direct on this. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be a rate cut?
No, I mean, your monetary policy has to be forward looking. That is elementary. You've got to be looking at, I always talk about the incoming data, the evolving outlook, and the balance of risks. We say that over and over and over again. Right. So it's always forward looking. If at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad. Right. So we took very aggressive forward looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, were in a bit of shock after April 2, but you see business sentiment, you talk to business people now, there's a very different feeling now that people are working their way through this and they understand how they're going to go. And it feels much more positive and constructive than it did 3 months ago, let's say. So again, we think that our current stance of monetary policy is in a good place.
Thank you. Amara Mokoy with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide that staff levels at the Fed should decline?
I don't see them at all as intention. So I was asked, is the Fed overstaffed? And I said, no, and I sort of said as a pun, overworked, but not overstaffed. People do work extremely hard at the Fed, and I know they work hard at Bloomberg too. So, but we work hard. But I would say this, so we are careful stewards of public resources, and sometimes you need to show that. So there have been several times in our history, modern history, where the Fed has said, you know what, we're going to do a buyout. We're going to show the public, we're going to demonstrate that we are good stewards of public resources. So we thought, and I thought that this is a time when we can, we grow at about, our headcount has grown at about 1% a year. So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're going to find 10% of employees who can do something else, where we can streamline our operations, and we think we can get there in a couple of years. We think we can do that. And we think this is without taking risk to carrying out our critical missions. So this is something you do very carefully, thoughtfully, and you do it again respecting that we have critical missions to carry out. I've had a lot of experience in my prior careers, with headcount reductions and things like that. And this is how you do it professionally. You do it carefully, thoughtfully, with a lot of planning, and you do it over a period of time. And I think the Fed will be fine. I think no one will notice any decline in our ability to carry out our missions. And I think it's just us wanting to demonstrate to the public that we are actually good stewards of their resources. We're effectively wiping out 10 years of headcount growth with this. So, I mean, we wanted to show that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the goal?
We're just at the very beginning. As you know, we're doing a buyout program. We're gonna hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it. at intervals, and you wind up not interfering with your ability to perform your jobs.
Claire.
And Chair Powell, Claire Jones from the Financial Times. As you're no doubt aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that influenced people's projections for 2026 and beyond. Thank you.
Yeah, so we don't sit around and debate or really discuss. We take fiscal policy as fully exogenous, and so we actually really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and the effects will be at the margin. I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate, but it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, we don't know the outcome yet there, so hard to be real specific.
Neil.
Thanks, Chair Powell. Neil Irwin with Axios. There have been some cutbacks in economic statistics collection in the last few weeks. Worries that long-running problems around funding and response rates may be getting worse. How much is this concern on your radar? How much confidence do you have that the gauges you're watching to assess the economy are reliable right now?
Two things. One, the data we get right now, we can do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see layoffs and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back and, from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps, it not just doesn't help the Fed, it helps the government, it helps Congress, it helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. The United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that, because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy and hence what's likely to happen. It's very hard to measure what's going on in the U.S. economy. If you read, there was a book called, it's really remarkable how many things you need to understand to estimate U.S. GDP. Very, very difficult. And it's so important that we get it right. I just would say it's not a place I would want to keep investing in that, for the good of the general public.
Victoria.
Hi, Victoria Guida with Politico. So you're conducting this monetary policy strategy framework review, but next year we're supposed to have a new Fed chair. And I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually be durable?
The framework document goes back to 2012, and it's the committee's document. It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on what's happening in the economy and what the committee wants to do. So, yeah, it isn't really tied to any particular chair. And we used to renew it every year. Now we do it every 5 years. So, but I don't think I've never heard anyone raise this issue that, a new chair might want to come in and go in a completely different direction. I really don't think that's right. But, but that's not going to be up to me to decide.
Is that affecting at all who you're consulting with?
Not at all. Not in any way.
Thank you. Chair Powell, Matt Egan from CNN.
relatively low gas prices this year have helped drive down inflation in recent reports, but that trend is starting to reverse given the crisis in the Middle East. How are you thinking about how the Israel-Iran conflict will impact the economy, especially inflation? And what lessons were learned during the 2022 period when another conflict, the Russia-Ukraine war, sent oil and gas prices skyrocketing?
So, of course, we're watching, like everybody else is, what's going on. I really don't have any comment on that. Possible that we'll see higher energy prices. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but tends to come down. Those things don't generally tend to have lasting effects on inflation, although, of course, in the 1970s, they famously did because you had a series of very, very large shocks. But we haven't seen anything like that now. The U.S. economy is far less dependent on foreign oil than it was back in the 1970s. So, but there.
A quick follow-up. I've just got to ask you about artificial intelligence. Some technology executives have recently been warning that AI could wipe out a large chunk of entry-level jobs and significantly increase the unemployment rate. I'm wondering how concerned you are, if at all, about the threat that AI poses to employment.
So this is the question. The question really is, will AI be more augmenting labor or replacing labor? And I wouldn't, we all see those announcements, including one today. I wouldn't, overread a couple of data points because, AI should be creating jobs at the same time. It may be replacing, maybe doing both. Anyone who's done any work with AI will have been a little bit stunned at how capable it is. And it's just a different thing. So I think this is something that certainly has transformational potential. And probably we're in the very early stages of it. They say what you're seeing now compared to what you'll see in 2 years is going to be very different and even more effective. So I think it's really hard to know. Of course, there are optimists who feel like it's going to make everybody much more productive. And there are those who think it's going to replace an awful lot of jobs right across the income spectrum, white collar, blue collar, and everything. So I just don't know. We don't have a house view on that, but this is going to be a very important question for some time.
Greg.
Thank you. Greg Rapp from MarketWatch. I was wondering if you could step back a little bit, Chair Powell. There's a spate of articles and a lot of op-eds now in the newspapers saying that the U.S. economy and the global economy is going through this profound change, akin to the end of the Bretton Woods era in the 1970s. And don't you owe the American people some sort of explanation for what we're going through? I mean, I noticed earlier this month when you talked about Bretton Woods a little bit, and you said that Bretton Woods, the Fed staff had to change how the dollar movements of the dollar wasn't impacting the economy. Are we going through something like that now? That, are you having to change how you do monetary policy? Is it that fundamental a change underway? Thanks.
It's certainly a time of real change. From a geopolitical standpoint, from a trade standpoint, from an immigration standpoint, you see this not just here, but everywhere. So there's quite a lot going on. It doesn't change the way we do monetary policy in the near term. But it doesn't change our objectives or what we need to do. And, these things are not really our issues. They're really issues for elected governments. All of those issues are really for elected governments. But there's no question it's a time of real change and very hard to see where that goes. Will it be, there have been many, many things written about how it's going to be a more inflationary time. That's possible. It's not guaranteed. AI could cut in the very other direction. AI could make people much more productive and push in the other direction. I don't know though. So, but you're right. But honestly, our focus is a much more practical one. And that is, how do we keep inflation low and employment high in the near term? That's really what we're about.
Mark Hamrick.
Thank you. Hello, Chairman Powell. Mark Hamrick with Bankrate.
What is the view about the growing amount of slack in the job market, including the softening in payrolls, the forecast of a modest rise in the unemployment rate, and the ability of workers to demand wage hikes or not in this environment where you have inflation surging?
You don't really see unemployment going up. You don't see increased slack, really. I mean, at the margin, remember, you're at 4.2% unemployment. That was, for many, many years, that was a extremely low level. It happens to have come up off of an even lower level as we came out of the pandemic. We were as low as 3.4%, but 4.2% is probably at the low end of estimates of the longer run, sustainable level of natural rate of unemployment. So I guess I wouldn't agree with that. And also, in terms of wages, real wages after inflation have been moving up sort of more than was consistent with 2% inflation. They're still moving up at a healthy clip, and I think much more consistent with 2% inflation given a reasonable assessment of trend productivity. So it's a pretty good labor market. You're right that the level of job creation has come down, but so has the supply of workers, the change in the supply, the new supply. So you've seen the unemployment rate remain pretty stable at 4.2. It's been as high as 4.3, but those are good numbers. So it's a pretty good labor market. There's a more concerning thing is there are not a lot of layoffs, but there are not a lot of job creation. If you're out of work, it's hard to find a job, but very few people are being laid off at this point. So that's an equilibrium we watch very, very carefully, because if there were to be significant layoffs and the job finding rate were to remain this low, you would have an increase in unemployment fairly quickly. But that hasn't happened. It really hasn't happened. The U.S. economy has defied all kinds of forecasts for it to weaken really over the last 3 years. And it's been remarkable to see just again and again when people think it's going to weaken. Now, eventually it will, but we don't see signs of that now.
Go to Jean for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. There's been a lot of talk about cuts. I wanted to ask you, why do you think there are no forecasts for rates to rise or even to stay where they are next year, given that the projection for inflation is to rise to 3%, and there's some skepticism over whether those price hikes will be a one-time event?
So there are a number of people on the committee who wrote down no cuts this year, but some cuts next year. So I think, people are writing down their most likely path, right? They're not saying there's zero possibility of other things. Really, think of it as the least unlikely path in a situation like this where uncertainty is very high. I think, again, people write down their rate paths, and they do not have like a really high conviction that this is exactly what's going to happen over the next 2 years. No one feels that way about their rate path. They feel like, what am I going to write down? I mean, what would you write down? It's not easy to do that with confidence. So I would just say it that way. We don't rule things in or out. Certainly a hike is not the base case at all. It's not something people are writing down. But in the meantime, we do the best we can with these forecasts. And I think they're representative of the different forecasts and different reaction functions that people on the committee have. So thank you very much. Thanks.
And with that, welcome to Closing Bell. I'm Scott Wapner, live from Post 9 right here at the New York Stock Exchange as usual. That was the Fed chair, of course, following a meeting in which the Federal Reserve made no changes to interest rates, but the outlook was always going to be the most important part of what happened today, as you know. The Fed did increase its inflation outlook. It did cut its growth forecast. A more stagflationary outlook, you could say, steps down for the economy and some steps up for inflation. He did say still that the economy continues to expand at a solid pace, even with all of the uncertainty caused by tariffs. Very importantly, 7 members now calling for no rate cuts this year. That's up from 4 at the last projection in March. Chair Powell saying the Fed is, quote, well positioned to wait and see what happens both on the tariff and employment front. Markets, very interesting story. Green right after the statement, perhaps because the market's like, well, okay, I'd rather have a strong economy than rate cuts. But at about, let's say, 252, 253, you did have some very interesting moves in the market. You had stocks sell off, you had bonds move up, perhaps because of this line. We expect a meaningful amount of inflation, the Fed chair said, to arrive in coming months and need to take that into account. We take all of that into account as we welcome in Jeffrey Gundlach. He's the CEO, CIO, and founder of Double Line Capital. Good to see you. It's always great to have you on these Fed days, Jeffrey. What was your biggest takeaway from what you heard from the chair?
It seemed like kind of a repeat of the last press conference, except I think his messaging was a little crisper this time around. Last time it was sort of like, we don't know anything, which doesn't sound very good. And this time it was sort of a wait and see. And we're getting to a point, I've talked about this at the meetings all year, where we started the year in January with the Fed saying, we're in a great place. Because everything was kind of going their way. And now with the adjustments to the SEP in March and now today, they're kind of incrementally moving in the wrong direction. You know, inflation has come down, but as you just referenced, Jay Powell knows, just like everybody I think knows, that there's upside risk to inflation numbers. And meanwhile, the unemployment rate, while it's pretty well contained, there's some very worthwhile, not high frequency, but long-term indicators that are worrisome on the unemployment rate going higher. On the inflation side, you basically know that the base effects, meaning the numbers that are rolling off from a year ago, are very low numbers. On the CPI, there's a 0 and a 0.1 rolling off the next 2 months. So those will probably be replaced with numbers that are higher than that. And so the Fed knows the inflation rate is going to be probably worse at the next meeting and perhaps also at year end. So they upgraded their inflation forecast. The three things, you know, you got the base effect I just said. You also have oil, which is up. Obviously, it could be a short-term spike based on tensions, but it's up over $10. It's up 20%. And every $10 that crude oil goes up, if it's sustained, adds about 0.4 to the headline CPI. So we've got the base effect, probably going to add a couple tenths to CPI. We've got crude oil, if it sticks, maybe adding 4 tenths between now and year end. And then you've got the tariffs, of course, which are very unknown. And one thing that's clear from Powell's answers to the questions is he thinks tariffs are inflationary. There's all kinds of arguments that it might slow down, you know, destroy demand, slow down the economy and all that. But it's basically, he believes it's inflationary, someone has to pay it. And that might mean that margins could be incrementally lowered. And of course, we've seen earnings estimates go down moderately for this year. So the mandate keeps getting, the dual mandate keeps running into increasing tensions. And at one point, that's why I think he said wait and see. At some point, one of these dual mandates is going to win out over the other one. And I think, and they're going to have to pick one. And I think they will pick the fighting the rise in unemployment more than fighting the rise in inflation. It seems like we're being prepared for higher inflation numbers that are very likely to happen. And he talks about maybe there's a one-time effect from tariffs and that dissipates in 2026, but maybe it won't. And so we'll have to see what happens with that. But in the bond market, what we've seen is a steepening yield curve. We've seen long rates going up substantially more than short-term interest rates, which is the bond market's way, in my view, of taking sides and saying, it looks to me like they're going to say, we're going to cut rates, even though inflation is probably higher than 3% between now and year end. And so if the unemployment rate goes up, they're probably going to be more likely to cut rates, even if the inflation rate's at 3.5%. The two indicators that I'm really focusing on for the employment rate is the yield curve, of course, has steepened and de-inverted. And the indicator that I think is the most valuable is the 1-year moving average of the 2s, 10s yield curve. Because when it goes positive on a 12-month moving average basis, that's, for the past 35 years, that's been right at the front end of a recession. And it is above now its 12-month moving average. So we're going to monitor that very carefully in the months ahead. The other thing is the U3 unemployment rate, which is at 4.2% now. versus its 36-month or 3-year moving average. And when that crosses above its 3-year moving average, going back all the way to 1990, so 35 years, you've seen that right when it crosses above, you're at the front end of a recession. And that has already happened, but it's not yet, it's not accelerating. In the past, when it goes to its 36-month moving average, it accelerates. That has not happened yet. And so what we're watching very carefully is the continuing claims, which have been rising for the last 2 years, and they foreshadowed the moderate increase we've had so far in the U3 unemployment rate. But continuing claims keep rising. And so we're going to be watching that on a real-time basis, because if that continues to move higher, it strongly suggests to me the unemployment rate will be moving higher. Also, one thing I want to point out is poor Jay Powell has been dealing with 5 years of incredibly unusual data. You know, the money printing, and then the surge in the bottle chain, the supply chain problems, and then the reversal of all of that. And now we have these tariffs, and now we have all these tensions in the Middle East affecting the most important commodity for inflation, which is oil. So I understand his wait and see approach, but in the end of the day, I'm just trying to divine the meaning of the bond market. I think we believe that they're going to be more likely to cut interest rates even against a rising CPI or PCE as we move forward through the end of this year and into 2026. And so I believe that this yield curve steepening is a trend that has been in place for a while now, and I think it's going to continue with the Fed likely to keep pressure lower on short-term interest rates. I do think it's interesting that there is no talk whatsoever of a hike. I thought there were some questions in the Q&A that were relevant to that point, but it's clear that everyone on the Fed thinks that the next move in rates is lower. And that further corroborates my idea that ultimately when the mandate comes into tension, they're going to look for to improve employment rather than to fight inflation, as long as it's moderately above 3% only. So that's kind of my takeaway for the meeting. Not a lot of new information, but it is a very, a lot of moving parts going on with economic data and tariffs and war. I mean, what else can you throw into that equation other than some sort of natural disaster?
It's clear that the chair thinks that the president's tariffs have a decent chance of wrecking both sides of their mandate by pushing inflation up and causing, the labor market to deteriorate at some point. It's just impossible to know at this point which has the potential of happening first, as you say, but you obviously have a view on how they would react, one versus the other. It's interesting, when you were with me last time, you did say that the long end was going to continue to rise. On May 7th, the 30-year was 478. We're at 488, 489 now. I did think it was pretty interesting when, the Fed chair has talked about inflation as a result of the tariffs being transitory, but that one line really stuck with me, and it moved the market undoubtedly when he said, we expect a meaningful amount of inflation to arrive in coming months and need to take that into account. I think he's saying as a result of all of that, we're justified in not knowing what the next move will be because we just don't know what the impact of all this is going to be still.
Well, I think that's absolutely right. I mean, as I said, inflation is very likely to go up. They know that. They don't want to be embarrassed and to be blindsided by what could be a 1% increase in the inflation rate, depending upon what the tariff effect is. Just the oil effect is significant. And like I said, the base effects are also going to be problematic with numbers coming out probably higher than the ones rolling off. So there's a lot of uncertainty, and the wait and see is right. But it's interesting, you mentioned the 30-year is up about 11 basis points since the last Fed meeting, but the whole curve is up basically by 11 basis points. There's been very little movement. I think the wait and see attitude that the Fed is articulating is very similar to what's going on in the bond market. I mean, there's been very little volatility in rates. The bond market is also signaling a wait and see attitude. And we saw a big drop in risk assets in April, and we saw a great big widening on the spreads of lower credit versus treasuries. like the high yield index went from 250 basis points over treasuries to 450 basis points over treasuries. And, you know, that has been almost entirely reversed. And same is true for emerging market debt, which widened out by 200 basis points versus treasuries. And if you exclude Venezuela, which messes up the emerging market spread data because it wasn't in the index and it came into the index and it's very high yielding. And so it created distortion on the spread. So if you want to analyze apples to apples, you just look at emerging markets ex Venezuela, and they're really all the way back to where they started. So everything has had tremendous volatility, but we're all the way back. And the market is starting to look at stresses in parts of the credit market. One thing that's really kind of weird is that the bank loan market, the CCC bank loan market, which is the most vulnerable area of the credit market, in my view, the spreads on CCC bank loans have actually come in this year, which makes no sense to me, because CCC lenders are paying 425 basis points higher now than they were a few years ago, and the Fed is not cutting rates. And so the pressure on CCC bank loans is starting to mount because they've fully reset up 425 basis points. Some of these companies are paying 10 or 11%, and some of their, and yet the spreads are in, and yet the defaults are mounting in the CCC sector of the bank loan market. It's very strange to me that the lower tiers of the bank loan market have improved in terms of their prices versus treasuries, whereas regular way high yield, the fixed rate stuff, which doesn't have hardly any pressure on it relative to these bank loans, the CCC high yield market has widened out. So it seems like it should be the opposite to me. But at this point in time, we continue to favor liquidity. We continue to favor avoiding lower tiers of credit, systematically looking to upgrade. I think now is yet another opportunity to do another tranche of upgrading of fractions of the portfolio, because we're right back to where we were pre-April 2nd in terms of markets broadly. You know, stock market's almost fully recovered. It's actually now about as overvalued as it was at the peak, because we've had earnings being downgraded, and yet, you know, the stock market has largely improved. It's down a little bit from its peaks, but really the valuation, it's funny when markets go down and you go into, you know, down 10, 15, 20%, people in hindsight look back and say, yeah, it was kind of overvalued. I probably should have stepped aside, but we're right back to those levels now. And not surprisingly, everyone has forgotten about what they thought they learned on the last drawdown.
Well,
so one of the
we're
things go ahead.
I was going to say we're 2% from a new high on the S&P. Let me just break away for a moment, Jeffrey, and I'll come right back to you, because Steve Leisman's left the room, and I do want to bring him in. A couple things are clear here to me, Steve. Number one, it seems the Fed chair believes that the tariffs have put both sides of the mandate into question, and they're going to have to wait and see on how to deal with all of that. And that Powell himself doesn't seem to be a huge fan of these SEPs either. And he revisited the refrain from the last meeting, throwing back at the reporter who asked him the question, what would you write? We'll do the best we can. Because they just don't know. And he pretty much told you to take it with a grain of salt without using those exact words.
Yeah, and by the way, the grain of salt is actually a number in the SEP where they talk about the uncertainty, and those uncertainty levels around their own forecasts, they acknowledge to be very high right now. I guess when Jeffrey was talking, Scott, I remember the day I was on a boat and I had a east-west swell, a west-to-east wind, and a north-to-south rip. The waters are very turbulent right now. And it's interesting. Well, first, let's hear what the Fed chair said about the outlook and what might be coming this summer.
One of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
So, Scott, in something that we were talking about, he did say he expected a meaningful increase in inflation. And that's something I think that's very important for what the market is expecting. And it hadn't seen it. It maybe thought it was out of the woods, but that's not the expectation of the Fed or any of the forecasts that I've been talking about for several weeks now. What is really interesting, Scott, if you take a look at the changes to the forecast, something is gonna not happen there. Here we go. We reduced GDP by 0.3. we raised PCE by 0.3 and core PCE, and we're going to cut the funds rate essentially by 50 basis points. I don't think you're going to cut the funds rate by 50 basis points if you get a 3.1% core PCE. And if that GDP number happens, well, I don't know what happens in that case, but I just don't think you're going to get that 50 basis points of cuts if indeed you're going to have that increase in inflation. That's why I asked him about scenarios, but he wasn't necessarily willing to give me the details on it.
Yeah, he doesn't want to deal in hypotheticals. I mean, he's made that case over and over again. Steve, thank you very much. Steve Leisman, I need to get to Eamon Javers now because the pool was in the White House in the Oval, and there are some headlines coming out of there. Eamon, what do we know?
Scott, this was a president who was very ambivalent seeming about the prospect of using military force in Iran. He was holding a photo op, really, with the Juventus soccer team, which is in D.C. Today for a game. And while he was there, he talked to reporters, and he expressed his deep ambivalence about the idea of the U.S. joining the Israelis in the war against Iran, saying that he doesn't want to fight, but sometimes you have to fight, saying that he's been adamant all along that the Iranians cannot be allowed to have a nuclear weapon, saying it's his belief that they were just about a week or so away from getting to a nuclear weapon at the time the Israelis began their attack, and also saying that he's got a meeting coming up in the Situation Room, which he called the War Room, in about an hour from now, Scott. So that gives us a little bit more insight into the decision-making process over the White House. But this is just from tone of voice, body language, the word choice. You'd have to say this president is deeply ambivalent, Scott, about the prospect of U.S. military action. He said he still hasn't made a final decision.
Yeah, thanks for the update. It's Eamon Javers for us in Washington. We're back with Jeffrey Gundlach.
Boom. All right, let's go ahead and do a recap. Yeah, let's do a recap here. I'm going to do a little evaluation of what we're seeing, or just a breakdown. What were the most important points here? All right, so let's talk about that. I'm gonna go ahead and switch to the market so we can see that. I think let's go to this chart. Right, we have communications stocks sort of rising, which is a good sign that although the overall market might be weak in certain sectors, you do have strength somewhere. We're gonna get to that, but first, let's go. Let's go ahead and throw up the daily chart of the S&P, right? Because we're really knocking on these all-time highs, and everybody's going to be expecting, do we roll over? What are we looking for? That is a wall, right? We're looking at this wall being violated once we have enough catalyst, and I still think it's coming. I think this is the strongest bull market in history that we're about to see unleashed. Once we have clarity, it could take the rest of the year, September, whatever it is. Now, remember, the rate cut is not what is important. What's important is the Fed turning dovish enough for the market to say, okay, the risks have dissipated enough so we can risk on. There's a lot of cash on the sideline, trillions of cash on the sideline. You have the Democratic Liberal Party, whatever you want to call it, who's a lot more, risk averse in this situation, where the Republican side, right, they're passing all these bills through the House, through the Senate, a lot more bullish. So in the short term, red flag here, dovish hold, right? It is Powell was dovish. He was very confident, but we're looking at a dovish hold. In my view, he's going to hold because why? Because in the short term, 3 to 6 months, you could say, there's no clarity for him to make a cut, or he's not going to raise rates. That's crazy. Nobody's raising rates, right? Whoever is preaching that crap is tripping. They're too politically driven. There's no raising of rates happening. The only rates going up is possibly 10-year rates, which is the market, not the Fed, right? So who's at risk here in the short term? Well, rates remain elevated for the bond market, and while the Fed refuses to cut until there's more clarity on trade policy. Who's at risk here? Real estate, right? Now, if you're in real estate stocks, which is a defensive sector, that means nothing, because the closer that real estate gets hurt, the more closer you get to a rate cut, emergency rate cut. But if you're holding real estate as not an asset in terms of markets, ETFs, if you're holding real estate I'm sorry, if you're in real estate, you might be in trouble, right? Because now you're going to have to push those costs further down the road with high rates. You're not going to get that cut. So real estate is at risk. That is an opportunity, both, and a huge red flag for employment or whatever it is. Slowing consumer. We saw retail sales start to slow down this month. We do have a slowing consumer. It's not really collapsing. Okay, this is good. You have slowing growth in certain areas, but you have hyper growth when it comes to infrastructure for data centers, when it comes for all the things that you need for compute. That's partly why goods inflation is picking up, because there's an extreme amount, and this is the super cycle we're about to see over the next 5 to 10 years. I can't look 10 years out, but I do have confidence that we're looking at a super cycle over the next 5 years with elevated rates, simply because growth will be very strong. And once you get the disinflationary effect from AI, that's when you really see markets start to expand. Here's the green flag: peak risks. Okay, so again, to wrap up the red flag, dovish in the short term, real estate's at risk, slowing consumer, uncertainty, but that sets up the rate cut. That sets up an easing in Q4, right? Maybe we don't get it this summer, but Q4, that sets up an easing, okay? Green flag. Green flag is we've already passed peak rates. According to Powell, we've already passed peak interest rates. I'm sorry, peak risks to the market as far as trade policy. The war he didn't really comment on. He kind of signaled that he's looking through it. It's kind of transitory. Usually oil spikes, come right back down. Let's take a look at oil, by the way, because that is an important macro factor. If it does get out of hand, then USO, am I tripping here? No, not that. Oh my gosh. I guess we could look at this. Let me see. Is this the same thing? No, I'm looking for US. Let's just go WTI. Crude oil, right? So the risks here is if we get above 80, then that is your bigger risk, right? But the green flag is that the peak risks for trade policy uncertainty is over. It's over. So what does that mean for markets? A lot of these capital intensive companies may suffer because they have to borrow at higher rates. Their yields, they're not yielding as much, but the software, the thematic assets are the ones that have the tailwind here. That's where we're seeing Symbiotic, SYMB, right? They have to borrow a lot of money, breaking out today. We talked about this yesterday. Symbiotic, what is this? This is automation. This is AI, robotics. Is it purely AI? Sort of, but it's mostly automation in manufacturing, right? Things starting to break out of this long wedge that's been forming for a minute. And why is that? Because these thematic assets are getting deregulated. They will explode, right? Thematic assets are going to explode over the next 6 months because you're getting deregulation. We're going to go over that. You're getting the big tax cut. That's why I'm not worried about slowing growth. We have slowing growth foreseeable as long as the tax cut doesn't happen, but it will happen. So there's a lot of forecasts you can think of here, but you're seeing, what are you seeing? Opal, look at these things exploding. This is another theme. Nuclear, we talked about this yesterday, right? It's pulling back today. What is looking good today? Something broke out today other than robotics. We're going to go over that next. So basically, stagflationary outlook, tariffs are the deciding factor. Tariffs are the deciding factor. You can tell Powell's not too worried about it. He wants to look through it, but on the shorthand, he can't. He can't just look through it. He can't say that. He has to be formal. And I think he really is saying, hey, look, we're not worried about policy so far as we go into the end of the summer. We're not too worried about policy. Yes, we do have more tariff stuff coming up, but Scott Bessent, who is, might be one of the Treasury or might be a Fed candidate for next year, he's not going to allow that to happen. He's a trade expert. Okay, let me throw my confidence out of there. I'm very confident about this. We're going to see the biggest bull market, and we're consolidating for that. Okay. Next, we expect a meaningful amount of CPI over the next couple of months. The market will price this in. That's the downside here. If the market starts to price in CPI increasing, then you might get, watch VIX over to, all I'm looking for is VIX over 20, right? If VIX can't get above 20, it's not really getting priced in. The market doesn't believe it. But as soon as we get VIX over 20 and a hold, okay, watch the VIX. Now you're saying, okay, the market's going to have a down cycle. Maybe it takes a month. Maybe we head all the way until July. Who knows, right? Inflation. Here's the thing about inflation now. corporate profits will remain strong. I'm not worried about earnings. Why? Because that inflation gets passed over to the consumer by some way or absorbed through automation. Corporations continue to make profits. Earnings are still strong, right? And even if those earnings start to weaken slightly, the tax cut would be passed and expectations for growth will increase again. I see you, Sweet Pea. I'm going to hit you right now. Inflation also, okay, here we go. Here's the other thing. The longer that Powell holds cuts, the longer the cycle happens, right? The longer we hold out on a rate cut and there's no real risks and the market is holding and it eats all this negativity, the longer the upcycle is going to be, right? Because he's delaying cuts and the market is still, trending higher to all-time highs. Once he starts actually cutting, right? You don't want him to cut right away. You want them to just cut to normalize the cycle. We're above trend inflation CPI. If you look at core, what they're focused on, it's at 2.5, 2.7 core. Are you kidding me? Rates are at what, 4.5%. So we have a lot of room to come down. This is a healthy framework. This is a healthy environment. Look at the VIX falling right now. I'm telling you guys, this is going to be a nasty rally when we get it. It's going to be vicious. And I'm early. Why? Because it's hard to digest and make a move when it happens right away. So I'm warning you now, don't get too bearish here, right? So the Fed, if they were to cut, it's going to be about employment. Jeffrey Gundlach talked about unemployment claims climbing. That's another key indicator. If we see unemployment claims jump, I think that might be a sign that Powell's going to have to pull that cut in, or the Fed's going to have to be a little more dovish. And that's always short-term pain, long-term gain when it comes to those events. So there's not too much different here other than Powell admitting, hey, look at shelter inflation is lower. That's the upside. Goods inflation is up. The question is that goods inflation up because tariffs are so terrible, or is it up because CapEx is exploding for AI, nuclear energy, overall technology in general, right? What am I bullish on? I'm bullish on blockchain technology. It's taken a while, but it's coming into the system. We just passed the Stablecoin Act, right? Through Congress. We just passed it through Congress. Now we got to go, through the Senate. Now it's up to the House. You see Coinbase exploding. We have Walmart going to stablecoins. We have JP Morgan creating stablecoins. That is the biggest, I think, upside thematic theme other than nuclear, but it's kind of wild, right? That's in real time. That's actually happening here. So who's rising in the short term? Communications, right? Communications are rising today and real estate is rising today. So what does that tell you? The bull market is still here. We're still in a bull market. It's a little defensive rotation. I don't think it means anything. I was keeping my eye on it to see who's actually up here. If we look at Reddit, Reddit is exploding today, right? So what is Reddit? Software. It has nothing to do with inflation. So these software or low capital intensive companies with a theme, they're going to still remain higher. This just tells you we have evidence that the bulls are still here. They just might rotate. Obviously, Google's a little different. They're getting disrupted. Netflix, Disney, Spotify. Let's see who else is up here. I don't think a lot of these are doing too great. Are defensives rotating up? Not necessarily. We also have real estate trust. Oh, here we go. ASTS, Space Mobile, right? Starting to break out. Now, this one is one, I had a friend who's talking about this for a while, right? This is a thematic. This is satellite technology, right? Satellite technology. And you're basically saying, right, aerospace, whatever you want to call it. I mean, this is a monster breakout. Keep your eye on this. The market cap is 14 billion. So it is considered a small, no, it's considered a mid cap. Looks like it's heading for large cap territory, breaking all-time highs. Looks a lot like Oklo did HIMS in the early days. Keep your eyes here. They're probably going to be competing with not Neuralink. They're probably going to be competing with, who is it? Elon satellites, right? Can't think of it. So ASTS, and I'll go over a couple names that I'm looking at right now. Like I said, SYM looks really good. So appetite for risk is real, still here. Okay, Sweet Pea, let's go ahead and hit you. If oil continues to go up, so will the price of food. Yes, if oil goes up, then your prices on food will go up. But for food to really go up, you're gonna want to see commodities overall. Let me go to let's see where wheat's at. Wheat's a big input to food because it feeds also, not only is it carbohydrates, but it is also feeding your cattle, right? See where commodities are at. Commodities are the real inflation trend Copper, not really moving. Lumber, oh, lumber's made a move up since May. Okay. So we do have some inflation pressures. Nat gas, I believe, exploding. So we're looking at some inflation pressure. Now, that just means in the short term. Does that mean we're coming fully back inflationary? No, because shelter's coming down, right? That's the biggest input cost. Most of the time, people's big, oh, okay, here we go. Sweet pea, here you go. Here's your confirmation. Wheat moving up. So we do have, and if the Straits of Hormuz, what is it? The Strait of Hormuz, whatever. If that gets blocked, then that's not going to be good, right? That's our bigger risk also. So this conflict needs to end somehow for markets in the long term. Very optimistic, but in the next 3 months, and my original prediction is we're looking great, and then boom, this war started, which oil prices go up, we're in trouble, right? Why? Because multiple commodities start to rise, all the shorts get squeezed. Now your input costs to run most businesses start to rise. Nothing changed today. Powell's report, same old, 100%. Sweet pea, that's pretty much what we're looking at. All right. Now, so yeah, it looks like we're looking at some inflation. Now, this is going to be a rotation in markets. I don't think it's necessarily macro terrible, because the long-term stuff like shelter is coming down. That's very positive. It's going to be about goods, and goods are easier to adjust simply because you can do tricks with, goods is automation, or you can use automation for goods, right? Next, let's go over, hey, if you guys want to get defensive, by the way, SGov, if you want short-term treasuries. Now, why would you look for short-term treasuries? Why would you want to lock these in? They don't really move. There's no volatility, right? SGov is paying. This is a very defensive play. AUM 49 billion in assets under management, very solid base. Dividend yield is 4%. You're basically getting 4% with nothing. Now, yes, you can do that in cash, but if you want to see an ETF, then you can look at that. That's just one defensive move for people who are very worried about inflation or some type of event that happens. Maybe you get a little defensive. Am I interested in that? No, I'm interested in these high beta assets from which we're going to look at right now. Okay, we're going to finish off with that. So number one, ASTS breaking out. Okay, is this a long-term hold? This is more of a trade. It looks like HIMS, right? Broke the downtrend, starting to rise. That is beautiful. I would look at calls into 2027 or late 2026, because we have a lot of time. Those calls are going to be cheap, but you're better off if the VIX spikes, right? This is very strategic. If the VIX spikes, then you get your calls, right? Then you buy your, I'm sorry, no, I'm wrong. Buy your calls now. You only sell calls when the VIX spikes. So buy calls while the VIX is low, and when the VIX rises, they will inflate. The value of those will inflate. So you can sell calls to get long. Also, I know that's a little more strategic for those of you who understand options. ASTS, that's one of the nice high beta stocks. BBAI, these AI plays are really trying to come up. I'm not a fan of Big Bear AI. I know they got a defense contract. That's good. I don't think it's ready to move yet. I'd be a little more patient. Neither this one either. This is SoundHound. Tempest AI, this can break out at any time with deregulation. Remember, deregulation, they are passing a lot of stuff for AI to go in the healthcare system or in biometrics, right? You have the Whoop strap. They're going to be using AI for that. So these could break out in any day without the macro narratives. They don't need a macro narrative necessarily, because they're high beta cyclicals with a theme on them. So you just want to make sure you're not buying it at a high price. What does that mean? I don't know. Subscribe to the newsletter and you'll be able to see how I process that information. It is free right now. It won't be free forever, but I wanted to prove my track record before we get started, before we actually make that a paid subscription. It is not going to be a lot. It'll be $10. I mean, you're going to make that back within one trade, right? You're going to make that back. Next, we have Wolf. What is this? This is the energy complex, high beta cyclical renewable energy. We're talking hydro, nat gas, nuclear, right? And they have a small nuclear arsenal. They power blockchain for Bitcoin, and they're also powering data centers. So this is a small cap also. Yeah, very small cap stock. Very bullish on small caps. It's already broken the downtrend, right? Keep your eye on Wolf. These will be, like I said, these will be in the portfolio. That is a newsletter that's going to come out, I think, on Thursdays. I'm not sure. I don't know when to do it on Friday. I want to make sure I do it on Thursday, so by Friday, what we're looking at here. So you got Wolf breaking out. It's still on trend. Remember, this is going to be carried by Bitcoin. They're a Bitcoin miner and a data center, they power data centers also, right? Located in the Northeast. I'll have a profile written out on that maybe every week on these new assets. So Wolf Energy, take a look into that. Don't trust me. Iran, talk about Iran. Iran, same thing as Wolf. I just like Wolf a little better. Iran is based in Texas, so it actually probably has better costs because of the oil in Texas. Okay. This watch list will also be in my Discord. If you're interested in the Discord, hit me up. Throw it in the chat. Matter of fact, if you're interested in the Discord, just go ahead and sign up to the newsletter, and you should be able to send me an email, right? If you're interested, sign up. If it's too much, throw it in the YouTube. Just throw it in the YouTube, and I'll throw it in the comments, and I will throw the Discord link if a lot of you want to jump in. It's free Discord. Okay. All right. Let's see. Yeah. So Oklo, you guys are already familiar with Oklo. I believe some of you. It's overbought, right? Now it's starting to move. Now, if you understand, I don't want to say if you understand, but if you keep up with the course, you understand that when RSI starts to drop above a very heightened level below the overbought territory, that's a red flag, right? I did it here, but now we're getting two. You had one, two, a third one, reverse head and shoulders here, or head and shoulders with RSI, just meaning the momentum's gone. I'm looking for a pullback into these anchored VWAPs from the low, from the previous high, somewhere around 40, 45 would be great. I mean, I want to see 30. Now, if it's in the 30s, boom, you got to attack. If you're in the 30s, you got to attack. Oklo deregulation is going to launch this asset. We're talking about high beta cyclicals, okay? But we're early in the cycle, so you have time. And they're starting to move up. The market is bottomed as far as that. SMR, same thing. Slightly different technical, same thing. You're looking for a pullback. And I want to say, as a matter of fact, let's do anchored VWAP from the previous high and the low. I haven't done this yet. I haven't set it up. We're looking at somewhere between 28, 25. I'd say 25 for SMR, got up to the 40s. These things move. High beta cyclicals. They are driven by the liquidity cycle and by the economic cycle. If you're interested to know how that works or what the hell is that, take my course on advanced macro. That is also going to be, I don't think I put it on YouTube, but you'll find it in my profile if you're interested. If not, don't worry about it. It is more advanced analysis, right? Now, this hasn't launched yet. This is nano nuclear. This is another nuclear. It has not picked up, but it is starting to break out. Now, this is it. SYM and nano nuclear. That was the other one breaking out. So this might be playing catch up. A lot of people chasing nuclear, looking for the next best thing. Now, is it a more trustworthy company? I don't think so. But when you're in a cyclical thematic theme, it's irrelevant. The thing goes forward. It might be a better trade than ownership, unless you have a small position. It's a small cap, so it could literally double within a month easily, just like Oklo and SMR did. I'm keeping my eye on this. Why? Because it is going to be breaking all-time highs again, right? It's looking at breaking at all-time highs again. That is the zone. Once you get above that zone, you're in all-time highs. You can see the MACD is starting to pick up. So keep your eye on NEE. Again, if you want this list, you want to understand more about it, subscribe to the free newsletter, get a hold of my information. I should have put it in the chat, but I was like, FOMC, nobody's going to pay attention. I'm going to add it to this YouTube link, the free newsletter after this. All right. All right. Who do we got next? Enovix. These are going to take a little longer. These are energy storage plays. Keep in mind, they're building batteries for energy storage. That is a theme that hasn't came online yet. It's a little higher tech. Obviously, Tesla's number one when it comes to energy storage. Batteries that conserve energy drives the cost down. Inflation disappears. You have a super cyclical bull market. These themes are going to be driving this monstrous bull market that we're about to see, driven by innovation and technology. Energy storage, nuclear energy. I mean, forget it. Forget oil. Nobody cares. Why? Because now you're powering the global economy through battery storage, through nuclear generation. Oil becomes a smaller portion. Nobody cares about war because, I mean, you do, the human cost, but financially, you're no longer dependent on oil as much. This is going to take time, but remember, stocks look 12 to 18 months out, and stuff like Tesla, they look 5 years out and price it in, right? All right. Fluence Energy. This is also forming a cup and handle or reverse a reverse head and shoulders. If you don't know what that is, check out my course. It's $1 on technical analysis for beginners. It is a $1 course, technical analysis. It has a quiz to make sure you're locking in the information. You have visuals. It's not boring. Go check it out if you're interested in the technicals. You can do it anytime. Okay, so Fluence Energy looks pretty good. I mean, just get a small portion, right? Not financial advice, but these things will boom once we start to shift past these a lot of this uncertainty. We are going to be we're seeing a lot of firepower from tax cuts and deregulation. That's it. I think the deregulation might be even more powerful, right? For investors anyway. For the economy, you need the tax cuts. Okay. Trade war de-escalation is going to be huge, and that's going to take a lot more time. All right, next we have exometry. The manufacturing cycle is still not here yet. You can look at the ISM manufacturing. That's one piece of growth. It's forward-looking GDP. The manufacturers basically look, you look across all industry and they say, are new orders picking up? Are they coming down? Are prices picking up? Are they coming down? Are we employing more? Are we employing less? That cycle hasn't even got into expansion. When it does, this stock will boom. This is a digital, it's like Amazon. Think about Amazon Marketplace for manufacturers, right? Instead of taking 12 days to find somebody, all of a sudden, boom, it does it in 30 seconds. The AI takes 11,000 distributors or suppliers and 8,000 different buyers who want custom manufacturing. And this is all over the planet, not just located in the US. And just look into exometry, you'll see the research. This one's going to be good, right? You just need to be patient. High beta cyclicals forming a strong flag wedge pattern, right? Maybe it makes another low. That's fine. You're really waiting for the breakout above 30, 40. And once you get above 40, it's game over. Long-term trend, we're looking at, I think it's kind of breaking the long-term trend. Yeah, I would say so. These all look very similar. They all look similar, right? Anyways, oh, you found it, Sweet Pea? Perfect. Yeah, $1. Go check it out. It's beginner for technical analysis. It's using TradingView too. So I know there's so many things like how to use TradingView, but once you figure it out, you'll be able to use it. Okay, and those courses will also be built upon. They're not just what's on there is going to keep getting built. It's going to be more, right? This is it takes time to do it, so I don't have them complete. Been working on them for a long time, but the point is they will be added to. They're going to be lifelong value. They don't just they're not just one and done. All right, next. Getting excited here. We have industrial services. You guys are familiar with flying cars. Okay. Now I'm not too robust on this right now, but there's something in the tax bill that talks about deregulating this industry. Okay. These are EV tolls. What are they called? EV tolls, basically electric vertical takeoffs. Okay. You have Archer and then you have Joby. Here's another one. They're the same. Look at the ticker. You'll find the ticker. Go do some research on it, or get a hold of the newsletter so you can see where I think is a good price point, good price to buy, and what kind of stock it is. All right, Symbotic. Now this thing is starting to break out. I've been watching this for a long time. This is very exciting. This is a really good theme. We're talking automation in manufacturing. Walmart is their biggest customer. And I mean, you're basically automating these warehouses, these gigantic warehouses with inventory with robots. They only get better over time. I think this one has a lot of potential. Still a high beta cyclical because it's still burning cash, but you want to get in early. It's starting to break out. Price action tells you something's happening, right? Next, you have Rocket Labs. Now, Rocket Labs, a lot of people love Rocket Labs. The catalyst here is going to be the IPO market. When you start getting rocket companies IPO, there's just going to be more investment here. So keep your eye on that. You also have Lunar. I don't know enough about this one. I'm not going to go into it. You all have RCAT. This is drone technology. It is breaking from a huge base, right? It's really starting to lift. I like the technicals here. It moves a lot like there's a lack of liquidity. This thing moves, but very small cap stock. I like the technicals. I'd probably look into anchored VWAP, the hold of the previous low. That's the average volume for support. As long as it holds and bounces, boom, I'm long. RCAT, what is it? Drone technology, right? A lot of it's packaged software for drone technology, and we're going to see a lot of drones, right? Very small cap, a lot of potential there. Now, last but not least, we have Chainlink. I know I always talk about Chainlink, but it is coming. Link USD. They just passed the Stable Coin Act Okay, the Stablecoin Act, yes, it's taken forever. Why? Because it hasn't passed the House yet. Once we pass the House, now you're looking at blockchain getting signed into law. I'm sorry, stablecoins getting signed into law. What does it do? It cuts off. It's the new ledger to the future, right? Finance is going to change. Now you're looking at Visa and MasterCard have to funnel into blockchain technology, create their own stable coins because it's cheaper, faster, more efficient. You don't need Visa and MasterCard. A lot of those earnings, a lot of that market cap value is going to shift into the infrastructure for the Web3 system or for the stablecoin slash blockchain decentralized financial system. That's what's coming. And I know it's a lot of words. I'll find a way to shorten it to make it more simple, but there is only one technology that can do audits, proof of reserves, proving that this system is true, proving with a golden record that this company says they have this amount of assets. It's or this bank has this much collateral and it's true. There's only one. It's Chainlink, proof of reserves. Nobody's even messing with Chainlink. I'm telling you, this is the biggest opportunity I've ever seen. I hope I survive it. Obviously, I hope I'm right. I went all in. I've done a lot of research on it, but don't go all in on it. Just get a little piece. It's going to pop, right? I'd rather have this than anything else, but I have a much higher risk tolerance than the average person. So if not, don't go all in. Just keep your eyes on it. Oh, thank you, Sweet Pea. I appreciate you. I hope everything's going well. Also here in Phoenix, it's hot as hell. All right. So stablecoin, Walmart's going to get a stablecoin. JP Morgan already built their stablecoin. They already built their private blockchain. Blockchain technology. The narrative is coming. It is coming. Okay. Let's look at Bitcoin really quick for price action. Bitcoin is just consolidating at this point. It hasn't dropped out. So we'll see. I think it's driven by liquidity. Keep in mind, M2 is rising, and this is what's driving Bitcoin is the global money supply measured by M2. Let's go ahead and throw that up. Okay, boom. Here we go. So this always leads Bitcoin by about 60 days, right? 60 to 90 days, meaning the peak in June, we're looking at August or the end of the July for Bitcoin to really break out. Remember, Bitcoin really moves within 10 days of the year. So you're not looking at, oh my God, I got to wait for it to trend. No, when it moves, and it moves within 3 to 4 days, then it rests, then it moves again. So I'm looking at the end of summer going into July. I always said June will be the correction. June will be the pullback. Cyclically, when I look at the internals of the market, when I look at market breadth, how many stocks are moving, risk appetite, what's moving up, defensive or cyclicals, offense. When I look at that, it looks like the end of June will be the next bottom or the phase where we start to rise into July. And I'm hoping we really get elevated in the end of July or August before we breathe again. That's all I have for you guys. I appreciate you. Stay blessed. Look at the message is this. You have a lot of stuff coming. Tax cuts, deregulation, trade war resolution. Stay positive. Stay patient. Think long term. We're looking at the greatest bull market of all time being formed as we speak. Appreciate you guys. Stay blessed. Eat healthy. Eat clean. Take a walk. Get in your 10,000 steps. Right? Get them muscles going. They have proven that muscle growth is better, is the number one predictor for longevity, is the amount of muscle in your body. Do squats, do biceps, do pull-ups, whatever it is, get muscle in your body, eat more protein. Let's live longer so we can enjoy the wealth that we're aiming to grow and to give, and to also unlock the knowledge for the younger generations, right? Because they're kind of screwed. So let's unlock this knowledge. Stay healthy, do everything positive. Appreciate you guys. Stay blessed. Catch you on the next one.